is a Fed rate hike coming once again? Well, let's discuss what happened and look at what to expect this week. Now, the rise in home loan rates over the last couple of weeks has mainly been in response to good news, from the banking sector. Corporate earnings from the likes of JP Morgan Chase, Bank of America, and Charles Schwab, plus others, it's really lifted fears of a banking contagion from the recent failures. And with those fears eroding, it's now brought back into focus the Federal Reserve and the threat of more rate hikes. Now, with bank failure fears easing, Fed officials have been speaking loudly about the need for more rate hikes. And some okay economic reports over the last week have also given the Fed cover to raise rates once again. And currently, there is an 85% chance the Fed will raise rates by a quarter point on May the 3rd. Now, the question is, will it be the last rate hike? Will 5 to 5.25 be that terminal rate? And if you listen to Fed officials, you'll hear a lot of mixed messages. Now, Fed President Bullard was speaking out this week saying he wants to see the Fed raise the rate to 5.75, which is an additional three-quarter point higher than current levels. And President Bostic had a more cautious tone saying the Fed should raise rates one time, pause and see how the economy responds to all the previous hikes. Now, as you can imagine, wildly different opinions from Fed members, well, it moves the markets all over the place. Now, the bond market is global, so when interest rates move higher in other parts of the world, it also puts upward pressure on our yields here at home as well. Midweek, the UK reported consumer inflation of over 10% when markets were looking for a reading below 10%. And if that were not enough, food inflation ran at the highest clip since 1977, and inflation in England is now moving twice as fast as it is here in the United States, with our CPI at 5%. Now, the stubbornly high inflation in the UK caused their interest rates to move higher, which lifted our interest rates to the highest levels in weeks. Now, the 10-year note yield, which ebbs and flows with home loan rates, is remaining beneath an important yield resistance level at 3.6%. And this is a key technical level which has been limiting the rise in rates over the past month. And with the banking crisis looking less likely for now, there is a threat that rates will drift higher, and the 10-year staying beneath 3.6% would be an excellent sign for mortgage rates long-term going down. Now, last Thursday, weekly initial jobless claims, a leading indicator of the labor market health, came in worse than expected, and it showed that more people signed up for first-time unemployment benefits. Now, the bad news is good news for the Fed, which has been looking for an uptick in unemployment. Now, on top of the Philadelphia Fed Index, which showed that manufacturing in that region slowed dramatically, that slower growth means less need for rate hikes. Now, the bottom line is this: home loan rates have stabilized for the time being. Spring is in the air, and the demand for housing remains high, and opportunities do exist for nimble would-be buyers. And in the end, bad news for the economy is good news for mortgage rates. And if you like this content, please like and follow my channel for more.